Silver is primed to gap higher overnight, not because of a headline, but because the price you continues staring at is the point was a paper I number, and the spread is quietly screaming the real one. The market is acting like it wants to be reassured, like it wants someone in a suit to step in and calm it down, and that's exactly why the next move is so dangerous. Because the pressure isn't coming from emotion, it's coming from mechanics. And the mechanics don't negotiate. You can feel it in how silver has been trading right now. Violent upside, violent pullbacks, and then this stubborn refusal to fully relax. That kind of tape doesn't happen when a market is done. It happens when positioning is being forced to reset in real time. It happens when liquidity is thin, leverage is high, and the system is trying to discover a price it doesn't want to admit. And if you stay with me, I'm going to show you the hidden detail that flips this whole setup. Why the calendar matters more than the news this week, and the exact zones that can trigger the kind of overnight jump people always pretend came out of nowhere. Here's the first thing you have to lock in. An overnight gap in silver isn't some mystical event. It's just what happens when the market runs out of resting orders. That's it. Price doesn't glide, it snaps. It prints the next available trade where liquidity exists. And silver, more than almost any mainstream metal, loves to do this because it lives at the intersection of two worlds that hate each other. Financial silver and physical silver. One is a leveraged, fast, paper-driven arena where participants can enter and exit with a click. The other is a supply chain with lead times, shipping constraints, refinery capacity, fabrication demand, and delivery schedules that don't care about your chart pattern. And when those two worlds drift out of alignment, the reconciliation doesn't happen politely at 2 p.m. in a deep, liquid session. It often happens at the worst time. Thin hours, reactive hours, the hours where stops are clustered and market makers widen spreads because they can. That's where the real pressure starts. Right now, the paper price has been whipping around a zone that recently saw an explosive run toward the low to mid 80s per ounce before slamming back into the mid 70s in the same breath. That's not normal trading behavior. That's a market that just tried to reprice itself and got punched by profit taking, margin pressure, and year-end book management. But here's the twist. That punch doesn't remove the underlying imbalance. It often intensifies it because it shakes out weak longs, reduces liquidity, and leaves a cleaner runway for the next forced move. And that's not the part that matters. What matters is what the structure behind the price is doing while everyone is hypnotized by the candle. In metals, especially in silver, the most honest part of the market is often not the flat price on the screen. It's the relationship between prices across time and location, the spreads, the term structure, the cost to carry, the ease or difficulty of sourcing metal for delivery versus rolling paper exposure forward. This is the stuff that quietly changes before the crowd notices. And when it changes, the crowd doesn't get a gentle reminder. They get an overnight gap. If you've ever watched Silver Gap and thought, how did it jump that far with no warning? The answer is almost always, there was warning, but it wasn't in the headline. It was in the plumbing. Let's talk about the physical symptom first, because it's the most intuitive. In a normal market, when price dips, physical premiums soften. Dealers get inventory moving again. Lead times shrink. That's how you know supply is comfortable. But in a stressed market, the opposite happens. Price dips and premiums stay sticky. Availability doesn't magically improve. The dip becomes a buying window for people who actually need metal, and the physical side refuses to confirm the paper sell-off. That's a tell. It's not proof by itself, but it's the first layer. Second layer is the hidden detail that most people skip because it sounds technical. The cost of getting silver now. When the market starts charging you more to borrow silver for a short period, when financing, leasing, and near-term sourcing start to feel tight, that is the market, admitting scarcity in the only language it speaks honestly. And when that cost rises, it changes behavior. It pressures shorts. It pressures anyone who is structurally short physical but long paper. It pressures arbitrage desks. It pressures industrial users who can't miss a production schedule. Because if you're short silver and you have to deliver, you don't get to say, I'll wait for sentiment to cool. You have to source metal or buy it back. And if the system is already tight, that scramble doesn't wait for the New York Open. It hits where it can. That's where the whole setup flips. Now, keep the tone grounded. I'm not saying there's a cartoon villain pulling levers. I'm saying incentives matter. Risk desks don't like surprises. Funds don't like delivery risk. Market makers don't like selling volatility into a structure that's shifting under them. When the underlying availability looks less reliable, the people who make markets protect themselves by widening spreads, reducing size, and raising the cost of leverage. And that's exactly the recipe for gaps. You saw a real-world example of this kind of stress recently when margin requirements in silver futures were hiked sharply. That's not a random rule change. That's a safety valve. It's the exchange effectively saying, this is moving too violently and we need more collateral in the system. But the irony is brutal. A higher margin can reduce speculative froth, yes, but it can also force liquidations, at the worst time thin liquidity further, and set up the next jump, because fewer players are willing or able to stand in the way. Because if this one level breaks, the math changes. So here's the mechanism in a clean chain without the fog. Silver trades on futures as the global reference. Futures price discovery is fast and leveraged. Physical flows are slower and constrained. When physical tightness rises, it shows up as stress in the near-term part of the curve. The market is willing to pay up for immediate availability relative to later delivery. That can manifest as a flattening of contango or even backwardation pressure in specific tenors, and it can show up as spread behavior that feels wrong if you only watch spot. When near-term delivery becomes more valuable, arbitrage desks step in. They buy where it's cheap, sell where it's rich, and move metal or paper exposure to capture the difference. That arbitrage is what drags the futures price toward the physical reality. Not opinions, not narratives, math. And once that drag reaches a point where the paper market is underhedged, the next layer kicks in, options and dealer hedging. This is where the overnight gap often comes from, and it's why the move can feel unstoppable in the moment. Dealers who sell options are not sitting there making a directional bet. They're managing risk. If price rises toward heavy call strikes, their hedging needs change. In simple terms, as price moves up, their delta exposure can increase, and to stay neutral, they often have to buy futures into strength. If the market is in a positive gamma zone, this can dampen moves. But if positioning shifts, if liquidity thins, if the strike landscape is stacked, you can get a reflexive loop where hedging becomes a mechanical bid. Not a bullish opinion. A forced purchase. Now put that in thin hours. Put that near round number magnets like 80. Put that near recent highs that everyone remembers. Put that into a year-end environment where books are being closed, risk is being cut, and the people who normally provide liquidity are operating defensively. That's how you get a print that jumps. That's how you get the gap. And here's the conflict. There are always forces that try to suppress or at least contain a move like this, not because they're evil, but because they're exposed. If a bank desk is short gamma, they don't want a runaway move. If an industrial user is underhedged, they don't want a spike. If a fund is running leverage, they don't want a gap that blows through stops. If an exchange sees volatility rising, it will tighten rules. That's the ecosystem trying to stabilize itself. But stabilization measures can accidentally create the conditions for the next discontinuity. That's the trap. Let's add the inventory reality, because this is where people get fooled by the wrong number. You'll hear inventories are high or inventories rose, and the market will shrug. But what matters in delivery-driven moments is not total inventory. It's deliverable inventory. It's the category that can actually be used to meet delivery obligations. In the silver ecosystem, you can have a lot of metal in the system that is not realistically available at the price, and timing the contract demands because it's tied up, earmarked in the wrong form in the wrong place, or owned by someone who's not selling. So when you see deliverable categories tighten relative to the total, that's a pressure signal. It means the paper promise is leaning more heavily on a thinner slice of real metal. And when that slice gets stressed, you don't get a calm reprice. You get a scramble. And a scramble loves to happen overnight. Now zoom out to global arbitrage, because silver is not trading in a vacuum. It's a global metal with refining and fabrication links that run through Asia, Europe, and the US. When a region experiences export restrictions or tighter flows, whether from policy, logistics, or industrial prioritization, it can create localized premiums. If one hub is bidding for immediate metal and another hub is quoting paper comfort, the gap between those hubs becomes a magnet. Arbitrage tries to close it. But the closing process isn't instantaneous when there are physical frictions. Shipping takes time. Refining capacity has constraints. Bar sizes and fabrication specs matter. And those frictions are exactly what allow spreads to stay distorted long enough to force a futures reprice. This is why you can have a day where silver sells off hard on the screen and the physical world doesn't really budge. That divergence is not sustainable forever. It either resolves by physical loosening or it resolves by price ripping back up. And when it resolves the second way, it's rarely gentle. Now let's talk why now, because this is not a timeless setup. The calendar is a catalyst. Year-end is not just a date on the wall, it's a set of forced actions. Funds rebalance. Risk managers demand lower exposure into holidays. Liquidity providers reduce size. Index-related flows reshuffle. Margin rule changes bite harder when people are already running tight. And then you get the first trading days of a new month where cash comes in, allocations reset, and the market suddenly has fresh demand meeting a thin order book. That's the kind of environment where a weekend gap or an overnight session doesn't to just reflect news. It reflects positioning being forced to adjust when there aren't enough counterparties. The next detail is what flips the whole setup. Because in environments like this, The most important trade is often not the one you see. It's the one someone is forced to do. A short who can't tolerate delivery risk, a desk that has to buy back gamma exposure, a fund that has to re-risk at the start of a new period, a hedger who missed the chance to lock in. Those flows don't announce themselves. They show up as price moving when it shouldn't. So where does the overnight gap specifically come from here? It comes from a confluence of three pressures that can align like gears. First, the curve pressure, near-term demand versus future supply. If the market is leaning toward paying up for immediacy, that's a hidden tightening signal. Second, the positioning pressure. If volatility is forced to shake out and leverage has been reduced, the book becomes thinner. Thin books gap. Third, the options pressure. If there's a strike zone overhead that, once breached, forces dealers and hedgers into mechanical buying, that buying can overwhelm available offers quickly, especially when liquidity is reduced. That's your gap engine. Now, let's anchor this to real visible zones without pretending we have prophetic precision. Silver has recently shown that the 70s are not safe. It can trade mid-70s and be minutes away from a violent move to the upside or downside. That tells you where the battle is. It's not a slow, trend-following market right now. It's a market in discovery. The first key zone is the mid-70s area that has acted like a violent pivot. When price is above it, the market behaves like it wants to test the highs again. When price is below it, it behaves like liquidation is in control. Watch how quickly it rejects or reclaims that zone. Speed matters more than the close right now, because speed tells you whether the move is forced. The second key zone is the psychological 80 region. Not because 80 is magical, but because it's a round number where options often cluster, stops cluster, and narratives cluster. People remember it. That memory creates behavior. If silver presses into 80 in thin liquidity and doesn't get rejected quickly, that's when the order book can hollow out. And if it hollows out, the next prints can show up several dollars higher before anyone can respond. That's how gaps are born. The third zone is the recent extreme highs in the low to mid-80s. That's the line the market can't unsee. If price takes that out with conviction, you shift from a narrative of profit-taking pullback to a narrative of continued reprice. And narratives matter because they change how participants behave with leverage and hedges. Here's the clean 2 scenario lens, because this is how you stay credible and how you stay sane. Scenario 1 is the controlled pullback and retest. Silver pulls back into support zones, volatility stays high but contained, and the market proves it can hold key areas without collapsing. In that scenario, you watch for higher lows, stabilization in spreads, and evidence that physical tightness doesn't disappear when price dips. Confirmation in this scenario looks like quick recoveries from sell-offs, shrinking downside follow-through, and that stubborn bid feeling returning as soon as price gives value. Scenario 2 is the continuation squeeze and gap risk. Silver doesn't give you the tidy retest. It pushes toward resistance, liquidity thins, and a single session, often overnight, prints through a cluster of stops and strikes. In this scenario, confirmation looks like a sharp acceleration near key levels, unusually fast moves during thin hours, and a sense that sellers are stepping back rather than stepping in. You'll see it in how quickly price reclaims levels it just lost. You'll see it in how dips stop getting bought politely and start getting bought aggressively. Both scenarios can happen in the same week. That's the point. Silver can rip, dump, and rip again while still moving toward a larger reprice. That's why volatility can whip you around even if the thesis is correct. Trend signal and noise can coexist, and silver is the master of making you confuse one for the other. Now let's address the psychology shield, because this is where retail gets harvested, especially in a market that can gap. Silver will try to manipulate you with speed. A fast red candle convinces you something broke. A fast green candle convinces you you're late. Both reactions are emotional. And emotional reactions are expensive in a market that moves discontinuously. The way you protect yourself is not by predicting every tick. It's by committing to what matters and what doesn't. What matters is the structure. Does silver hold or reclaim the key pivot zones after a sell-off? Do spreads and the curve behave like the market is paying for immediacy? Does physical behavior stay firm on dips? Do you see signs of mechanical buying near strike magnets? What doesn't matter is the intraday noise that exists solely to trigger stops and force impulsive decisions. Because in a market like this, stops become fuel. Now, when price slices through a level, it doesn't stop because the level was wrong. It often accelerates because the stop cluster became market orders. That acceleration is exactly what creates gaps, and it's exactly why you need to respect position sizing and time horizon. So if you're watching silver right now, the most practical question isn't, will it go up? It's, where does the move become forced? That is the level where people who don't want to buy are forced to buy. That's the level where shorts have to cover. That's the level where dealers hedge. That's the level where liquidity disappears. And in this tape, that forced zone often sits just above obvious resistance. right where the crowd expects a rejection. The S, it's why the move can feel like it has no one to stop it in the moment. Not because there are no sellers, but because the sellers don night have the balance sheet appetite to stand in front of forced flows. And once forced flows start, the only thing that stops them is either a sudden return of liquidity or a rule change that raises the cost of holding exposure. And even then, the price can still jump first. That's where the real pressure starts. Let's stack the proof in a way that a skeptical, macro-minded viewer can respect without pretending we know every proprietary number. 1. The volatility itself, combined with recent record highs and sharp retracements, is consistent with a market undergoing a structural reprice rather than a simple sentiment swing. When price can surge toward the 80s and then fall several dollars quickly, that's leverage and risk management at work. It's not a sleepy, balanced market. 2. Margin and risk controls have tightened in response to the volatility, which mechanically alters who can participate and how much liquidity is available. Less participation and wider spreads are precisely what make gaps more likely. 3. The physical symptom layer, premiums, and availability has shown stubbornness even when paper price cools. When the physical side doesn't relax with the chart, it suggests the underlying demand for actual metal is not purely speculative. 4. The supply chain narrative is not hypothetical. Silver demand is tied to industrial uses that don't vanish because a headline shifts. Solar deployment, electrification, data infrastructure, and electronics keep pulling metal through fabrication pipelines. That creates a baseline bid that is structurally different from a purely financial commodity. 5. Global flow disruptions and policy uncertainty around exports and strategic materials can create localized scarcity and premiums that eventually feed back into global pricing. You don't need a conspiracy, you need a bottleneck. 6. The market structure layer, spreads, curve behavior, and the incentive for arbitrage can force futures price discovery to catch up with physical tightness. When the curve pays for immediacy, it's a sign the system is leaning. 7. The options layer can turn any breakout above obvious resistance into a mechanical buying event, especially when liquidity is thin. That's how a chart level becomes a catalyst. No single layer is enough on its own. That's the point. It's the stack. Mechanism plus behavior plus structure plus calendar. And that stack is exactly why an overnight gap is not only possible, it's plausible. Now, the question you really care about, what comes next in the next week or two, and what should you watch so you're not just consuming adrenaline? First, watch how silver behaves around the mid-70s pivot zone. If sell-offs into that area keep getting absorbed quickly, and if rebounds are fast rather than slow, that supports the idea that the market is underpinned by real demand and forced cover risk. Second, watch the 80 region like a stress test, not like a target. If silver approaches it and stalls for days, that's different than silver approaching it and slicing through it in hours. Slow grind suggests liquidity exists and sellers are comfortable. Fast push suggests sellers are stepping back and hedgers are stepping in, and if it's fast, gap risk rises. Third, watch the behavior of volatility itself. Not the absolute number, the behavior. If volatility spikes on down moves, but then collapses quickly when price stabilizes, that often indicates liquidation is being absorbed. If volatility spikes on up moves and stays bid, that often indicates the market is paying for protection because participants fear continuation. That's where the setup tightens. Fourth, watch for any signs of spread stress or curve inversion pressure. You don't need to be a professional spread trader to understand the signal. If near-term pricing acts like it's more urgent than later pricing, that's the market saying now matters. And when now matters, shorts and hedgers lose flexibility. Fifth, watch institutional behavior indirectly. Do the vehicles that track silver show signs of renewed accumulation after dips? Do large players treat pullbacks as opportunities rather than exit ramps? You won't see every flow, but you can see the footprints in how resilient price becomes after a violent shakeout. Now here's your invalidation, because credibility lives here. If silver loses the key pivot zone and fails to reclaim it quickly, if it breaks down and then spends real time below, with rallies getting sold immediately, that weakens the forced upside argument in the near term. It doesn't erase the long-term structural story, but it says the market is not ready to gap higher yet. It says liquidity is still in control and the squeeze timing is wrong. On the other hand, the confirmation is brutally simple. If silver reclaims and holds key pivot zones, presses into the 80 region with speed, and you see that no one wants to stand in front of it feel, then the overnight gap becomes not just possible, but likely as a function of thin liquidity and forced flows. And if it takes out the recent highs with conviction, the next phase becomes a reprice discussion, not a trading range discussion. Because if this one level breaks, the math changes. Before we close, let's deal with the one way volatility will be used against you, because this is where people sabotage themselves, even when they were early and right. Silver doesn't need to defeat your thesis. It just needs to defeat your nerves. It does it by moving violently enough to make you violate your own process. You sell the dip because it hurts. You chase the rip because it scares you. Then you get shaken out on the next swing. That's the loop. The antidote is not bravado. The antidote is structure. Decide what time horizon you're operating on. Decide what level actually invalidates the near-term setup. Keep size small enough that a violent move doesn't force you to act emotionally. And most importantly, stop demanding that the market move in a straight line to prove you right. Silver doesn't do straight lines. It does pressure and release. It does liquidity vacuums. It does gapping. So here, on the clean takeaway, the reason silver can gap up overnight and feel like no one can stop it is not a mystical prediction. It's a market structure outcome. When the curve and the physical reality tighten, when positioning is forced to reset, when options hedging sits like a landmine above resistance, and when the calendar strips liquidity out of the book, price can jump through empty air. That's not drama. That's how a leveraged, global, two-world market behaves under stress. If you want to be on the right side of this without getting played, keep it simple. Watch the pivot zone in the mid-70s. Watch the behavior into 80. Watch whether moves are fast or slow. Watch for signs that immediacy is being priced. And keep the two scenarios in mind, either a controlled pullback and retest that sets a cleaner base, or a continuation squeeze that gives you no comfort and no warning. And if you're part of the crowd that refuses to be emotionally steered, if you're the type who wants mechanisms, not slogans, drop your key level and which scenario you think is more likely in the next week. Not because it helps the algorithm, but because it forces you to commit to a process instead of a feeling. That's how you build the edge that silver can't take from you, even when it tries to shake your hands off the wheel.